Financial accounting, FRK 321, hedging. Today we're going to do lecture number 3, hedging of a firm commitment. Let's just see what a firm commitment is again. It is a binding agreement for the exchange of a specified quantity of resources at a specified price on a specified future date. We're going to look at the fair value hedge, and remember, we recognize the exchange differences of fair value hedges in the profit and loss. Hedging of a firm commitment. So when you have your hedged item up to transaction date, that will be your firm commitment portion. Why? Because you've signed the contract to purchase this inventory or asset or what it may be, and now you want to hedge this commitment that you've made, that the price does not increase or that the exchange rate does not increase what you're going to pay for this. So from the date, if you look at the bottom there, from the date of your order, 30 June, until the date of your transaction, you are hedging this firm commitment. And because there was, you cannot really put through any transaction or any journal relating to the asset. So therefore we are now what we call creating this firm commitment liability. It could also be an asset. And we're creating this against the profit or loss directly. And as I said, the reason for that is there's no other transaction, and we need to hedge this and account for the hedge that we've done. Now, from the transaction date up to settlement dates, we are going to hedge the recognized asset or liability, which in this case will be the foreign creditor. So, on transaction date, you're not hedging that firm commitment anymore because the transaction has happened, and therefore you will put the asset in your books as a non-monetary asset, and on the other hand you'll have the creditor, which is still a monetary item and which is still have to be paid in the future, and it can have fluctuations. So therefore that item will be hedged for the next 2 periods until the end of the year, and then 31st of March is until the payment date. We also have the hedging instrument, which is the FEC, and the FEC will be valued and translated for that full period from 30 June until the end of March 20.6, because we took out the hedge for the whole period. So let's now move on to our class example number 2, and in this instance I would want you now to go to your handouts. Now on page 28 and 29 you will find our theory and our references to the firm commitment fair value hedge and firm commitment cash flow hedge, and then on page 30 there's the class example. So keep that handy with you, and then we can run through that class example as we go along. So there's the information. I will repeat this information again when we do the timeline. I just want you to read it yourself now. There's your class example, your rates, and they say on 30 June 20.5 the company designated the FEC as a hedging instrument and the foreign exchange risk component of the firm commitment and the foreign creditor, which arose as a result of the transaction. And on the previous one you also saw that we have inventories that has been sold at a certain date and further date. Please remember, I'm not going to go in that detail. Please remember to do those journals if that is asked in a question. So read your question carefully. And then in number 6, you just have that additional little note there: selling prices are determined by adding 25% of cost. You can go and look at that yourself in this question. Let's focus on the firm commitment and the firm commitment liability. There's the question, and we're going to treat it first as a cash flow hedge. So let's look at the timeline. On 30 June, that was your order date. And then on 30 September, that is your free on board date. And then year end 31 December 20.5. And then the creditor must be paid by 31 March 20.6. So therefore, our hedged item as we stated there, and remember the hedged item is the creditor that you're going to hedge. Now the first period, and there's your hedging instrument. Now your firm commitment will be valued on the same rate as the forward rate for that first period from order date until transaction date. Thereafter, there's no firm commitment anymore. Then it is the creditor, and the creditor will be translated at your spot rates, as we already know. So let's have a quick look at our journal entries. There on page 30 you will find the class example number 2, and then on page 31 you'll find the journal entries. Now, as we said previously, on 30 June, that was your order date. Is there any transactions on that date? No. No transaction has taken place yet, so therefore there's no journals for that date. But then on 30 September, when is your first reporting date, which is your transaction date, there is now this. Let's first look at the FEC. We're valuing the FEC, and how do you remember how we valued the FEC? If we look at the timeline, remember that the FEC, we look at the forward rates firstly, the forward rates there, and because the FEC was taken out on that date, that is your FEC, was taken out on that date at a rate, forward rate of 6 rand 2 cents. That will not change. The FEC is now fixed at 6 rand 2 cents. But we want to value that FEC. And the only way we can value it is by comparing it with future FEC values. So on 30 September, we go to the bank and we ask them, what will a 6-month contract be worth? And they tell you the 6-month contract would be worth 611. You compare that to the 602, and it's a 9 cents difference. Times that by your $100,000, and you get 9,000 rand, which was the movement. Now, because, as I said previously, you are fixed at 6 rand and 2 cents. If, and that's a big if, because we're not allowed to sell and buy and sell at FECs, but if you were to sell that FEC, you would sell it at 611. For that reason, we say you purchased it at 602, it could be sold at 611, so therefore it is a profit that is being made. So you can make a profit of 9,000, and for that reason we'll debit the FEC with 9,000 and we'll credit the foreign exchange profit with 9,000. And remember, it's a fair value hedge. That's why that entry is going against the foreign exchange profits. On the other side, we now have the firm commitment. Now the firm commitment moves in the same direction as the asset will move, your asset or liability, in other words your creditor. So if the spot rate increases, then you are making a loss. If the spot rate decreases, then you are making a profit. So for that reason, and as I said before to you, even with a firm commitment, we have to use the forward rates. And now, if you would have purchased this asset at order date, you would have only paid 602. But now it's transaction date, and now the transaction is at 611. So your firm commitment made a loss of 9,000 rands. And let's now go back to those journals. And there you can see your firm commitment made that loss of 9,000 rands. So we now made the journal number 1, we did journal number 2, and now let's look at journal number 3. Journal number 3 says creditor, debit inventories, credit creditor. So what is happening there? Remember, it's our transaction date. So on transaction date, we're now going to put into books, recognize the inventories at 610,000, the spot rate on transaction date, against the creditor at 610,000. Journal number 1, as you can see there, is your forex profit, 9,000 against the forex profit account. 9,000. So that's our first entry. Then journal number 2, as we said, we've got this firm commitment, and because it's making a loss, you debit the forex loss and you credit the firm commitment liability account. So journal number 2 will be your firm commitment 9,000, and there your journal number 2, your forex loss, and that is 9,000. So now you've brought that into your books. And remember now to do the creditor and the debtor, the inventories and the creditor as well on this date. And there we've done the inventories and the creditor as well. So now we've got a bird's eye view of this, the journal entries that we've done on transaction date. But there's now one other entry which is very important, because on transaction date your firm commitment has now stopped and the transaction has been done. So you had your transaction, your inventories is in your books, you've created the creditor. Now that firm commitment liability must be cleared out against the underlying asset that you've purchased, in this case your inventories. So therefore you will debit, and this will be then journal number 4, you will debit the firm commitment account with inventory 9,000. So whatever your balance in this account, you will clear it out against inventories. If this balance was a debit balance, then you would have cleared the debit out against inventories. In this case it's a credit, so we debit the firm commitment and we credit inventories with the firm commitment 9,000. So what effectively happens here? As you can see, the whole idea of the firm commitment, the hedging of the firm commitment, was to try and fix the value of this inventories as close as possible to order date. And this basically is what we've done by setting off this profit that we made on the one side against the creditor, or sorry, against the inventories on the other side. So, and that is what is the crux of this exercise and of this journal. Now all that we have to do is go through the motions. I'll do it for you once more until the end of December. The rest you can go and look at the journals yourself. The next step is now at year end. So there's your year end, 31 December 20.5, and we have to now calculate the movement between transaction date and year end. And when we look at the FEC again, we will take the 617, which is now a 3-month contract. That's how many months is remaining. So that is the information given. We compare it to the previous contract, and that difference is 6 cents. So therefore, times 100,000, the firm commit, the FEC will make a profit of 6,000. You can already think in your brain what will happen there. Debit the FEC asset, credit the forex profit with 6,000 rands. But on the other side we've got the hedged item, and that hedged item must also be translated, and the spot rate which we have there is 6 Rand 15. So if you compare that spot rate to the rate on transaction date, and that is now a 5 cents movement, giving us 5,000. And because on transaction date we would have paid 610 for the creditor, but now on the year end we are going to pay 615. So that, for that reason, we're going to actually, our liability is now more, and therefore we are making a loss on this creditor. So let's do those entries for you. Firstly, the FEC, journal number 5. Again, forex profit, and in this case it is 6,000 as we calculated, and there you'll have journal number 5, FEC asset and it is 6,000. As we said, we also have to restate the creditor. So the creditor, we have journal number 6, and we say the forex loss 5,000, and journal number 6 there is your creditor 5,000. That's a loss there. So now we are at year end. We've done the 2 year end journals, and our creditor has been restated. Now you can go and check the calculation. Your spot rate on that date is 615 times 100,000, so that means your creditor is stated at the correct amount. Your FEC has been valued. Inventory stays the same now, except for, remember, journal number 7 and journal number 8, where you have to now take out the cost of sales out of this account, and in this case it's 120,200, and take it to the cost of sales account. Cost of sale, that is inventories, 120,200. Please, I'm not going to do all the other journals. That is the crux of the matter. Let us just have a bird's eye view again of what we see here. There you have an overview of what we've just done. And remember, let's recap. Your profit that you make on the FEC, you will take directly to retained earnings. To profit and loss for the period. And on the other hand, you've got the firm commitment calculated on the same basis, and the adjustment in the firm commitment in this case is a loss of 9,000, so therefore you will debit profit and loss and you credit firm commitment. And then once a transaction has happened on transaction date, once that transaction has happened, now all that we've accumulated in this account will be taken out of this account. In this case we've accumulated a credit. We'll debit this account with 9,000 and we will credit the inventory account. Oops. You'll credit the inventory account with this 9,000. And that you can now go and look at the journals number 7 and 8 and 9 up to 13, but basically it's going through the motions. There's what you see on the screen is the crux of the matter. The next video will be on the same hedging of a firm commitment, but this time with a cash flow hedge. Thank you. Watch